Good morning, traders. The S&P 500 climbed more than 1% yesterday, and yet this morning our entry gate says, hold. Welcome to the VIXShield Daily Market Summary. Morning Outlook for Wednesday, April 15th, 2026. These signals and insights are for educational purposes only and are not financial advice. Trading involves substantial risk of loss. You can lose more than your initial investment. No live trade execution. Signals only. Past performance is not indicative of future results. This morning we are going to walk through what the market is telling us ahead of today's open, the volatility picture, the news driving sentiment, and exactly why our discipline system is keeping us on the sidelines for now. And we are going to talk about why that is not a disappointment. It is, in fact, the whole point. Let's begin. The S&P 500 closed yesterday at 6,967. That is a strong session, up roughly 1.2% on the day. The index is holding at elevated levels, and the price action, on its face, looks constructive. Now the CBOE Volatility Index, the VIX, that is where the real story lives this morning. The VIX settled at 17.87. That is down from 19.49 the day before, a decline of about 1.6 points, or roughly 8% in a single session. That is a meaningful drop. Volatility, in other words, compressed as stocks moved higher. That is the classic relationship. Equities up, fear down. But here is the important context. The VIX's 5-day moving average, the rolling average of the past 5 sessions, sits at 20.95. That means even with yesterday's decline, the VIX is still running about 14.5% below its recent average. That gap tells us something. It tells us the market has been living at higher anxiety levels recently, and yesterday's calm may be a short-term reprieve rather than a confirmed new regime. The term structure of volatility, how near-term fear compares to longer-dated expectations, is currently in contango. Now, contango simply means that 3-month volatility expectations are priced higher than what the VIX is showing right now. Specifically, the 3-month volatility measure, known as the VXV, sits at 20.82, nearly 3 full points above the current VIX reading. For income traders, contango is the normal, healthy state of markets. It means the options market is not in panic mode. It means the structure favors premium sellers, at least in terms of how the curve is shaped. Realized volatility, what the market has actually done over the past 10 trading days, came in at 17.2%. That is nearly in line with where the VIX is priced right now. Implied and realized volatility are running close together, which suggests options are not dramatically overpriced relative to actual market movement. In the broader market, the US dollar index fell about 0.5% yesterday, which generally signals a risk-on appetite, investors moving away from safe haven currencies. Bitcoin gained nearly 2%. Ethereum added just over 2% as well. Gold climbed about 1.5%, which is a slightly mixed signal, since gold rising alongside risk assets can sometimes suggest inflation hedging rather than pure risk appetite. And crude oil fell sharply, nearly 5%, which adds a layer of complexity to the inflation picture we will get to in a moment. Now let's look at what is driving sentiment this morning. Because the macro backdrop is anything but simple. Earnings season has delivered. That is the first headline worth noting. After weeks of anticipation, corporate results have, on balance, come in well enough to support the equity rally we saw yesterday. Traders are breathing a small sigh of relief. But, and this is important, the market's attention is already shifting. The question now is not what companies earned last quarter. The question is what the Federal Reserve does next. And behind that headline, we get the inflation data. Producer prices for March came in softer than expected. That is normally welcome news. Softer input costs suggest the inflation pipeline is cooling. But here's the complication. Rising oil prices tied to ongoing Middle East tensions are working against that narrative. Crude fell sharply yesterday, but geopolitical risk in energy markets does not resolve overnight. The Fed is watching energy prices carefully because they feed directly into consumer inflation with a lag. Which brings us to perhaps the most consequential headline of the morning. Fed Governor Goolsbee suggested that rate cuts may need to wait until 2027. Let that land for a moment. Not later this year, not early next year, 2027. That is a significant signal from inside the Federal Reserve, and it tells income traders something critical. The higher for longer rate environment is not going away quickly. For options traders, that means elevated implied volatility conditions could persist longer than many had hoped. Meanwhile, Treasury Secretary Bessent struck a different tone, urging the Fed to move sooner on rate cuts, even as he acknowledged that geopolitical conflict is complicating the inflation picture. This kind of tension between fiscal and monetary voices is not unusual, but it does add uncertainty to the policy outlook. Taken together, today's headlines told the story of a market caught between two forces: relief from earnings on one side, and a Federal Reserve that is in no hurry to ease on the other. That is not a crisis, but it is not a clear runway either. Heading into today's session, traders will be watching Fed commentary closely, monitoring energy prices, and gauging whether yesterday's equity strength has the follow-through to hold above the 6,900 level on the S&P 500. Now let's look beneath the surface at volatility, because this is where our decision-making framework lives. The VIX at 17.87 is encouraging. It is declining. It is below its 5-day average. The term structure is in contango. On paper, the volatility environment is moving in the right direction for premium selling strategies like the Iron Condor. But our system does not trade on direction alone. It trades on rules. The expected daily range, our EDR indicator, came in at 1.46%. That is just below our critical threshold of 1.5%. The EDR gate is met. That part of the filter is green. However, the VIX Entry Gate, the second filter, requires the VIX to be below 15 before a new position is authorized. This morning the VIX is at 17.87. That is nearly 3 full points above the threshold. The gate is not met. And so, for the 7th consecutive session, our system says, hold, 7 days in a row. That is not a malfunction. That is the system doing exactly what it was designed to do, keeping capital on the sidelines when conditions are not fully aligned. Now, the strategy insight for today. Let's be clear about what the hold decision means and what it does not mean. It does not mean the market is broken. It does not mean Iron Condors are a bad idea. It means one specific rule: the VIX Entry Gate has not been satisfied. The rule is straightforward. The VIX must be below 15, and the expected daily range must be below 1.5% before a new Iron Condor position is authorized. Today, only one of those two conditions is met, and 1 out of 2 is not enough. Now, this is a hold day, and hold days are most valuable when they are educational. So let's walk through what the structure would have looked like had conditions been met. On the conservative tier, the would-be Iron Condor strikes would have been centered around the 67.35 and 67.40 puts on the downside, and the 70.35 and 70.40 calls on the upside. That structure would have generated a net credit of 65 cents per contract, with a maximum loss of $435 and a risk-to-reward ratio of roughly 6.7 to 1. On the balanced tier, the strikes would have shifted inward slightly, 67.55 and 67.60 on the put side, 70.15 and 70.20 on the call side, for a net credit of $1.10 per contract, with a maximum loss of $390 and a risk-to-reward ratio of 3.5 to 1. The aggressive tier is not active today. These are the structures we would have evaluated, but we do not enter them, not today. The rules protect us from ourselves, from the temptation to trade just because the setup looks attractive. The theta time shift indicator is also worth noting. It is currently in forward mode, pointing to a 7-day duration target. The EDR temporal reading, a measure of time-adjusted volatility pressure, came in at 8.6%, well above its threshold of just under 1%. Combined with the VIX above 16, this signals that extending duration to capture additional vega, the sensitivity of options to volatility changes, could yield between 45 and 80 cents per contract. That is a note for when conditions do eventually align. On the protection side, 2 of our 3 ALVH hedge layers are active. The short-term spike guard and the medium-term wave shield are both running. The long-term endurance hedge is currently inactive, which is appropriate given the contango regime. The annual cost of maintaining this hedge structure runs between 1 and 2% of account value, roughly $250 to $500 per year, and is designed to offset 30 to 50% of Iron Condor losses in the event of a 10% or greater drop in the S&P 500. 7 consecutive hold days. Let's talk about what that actually means. In trading, the hardest discipline is inaction. Every day the market moves, something inside a trader says, do something, react, participate. And every day our system says, hold. That voice gets a little louder. But here is the truth that experienced traders learn. Sometimes the most profitable thing you can do is nothing. Every hold day that avoids a losing trade is, in the most literal sense, capital preserved. Capital that is available when the setup finally arrives. What would flip today's hold to a place signal? Simple. The VIX needs to close below 15. At 17.87, we are less than 3 points away. That is not an enormous gap. A continued compression in volatility, perhaps driven by positive Fed commentary, or a quiet geopolitical session, or simply a calm equity tape, could close that distance within a few days. Watch the VIX closely today. Watch whether the contango structure holds. Watch crude oil, which fell sharply yesterday. A continued decline there could ease inflation concerns and soften the Fed's tone, which in turn could compress volatility further. And watch the 6,900 level on the S&P 500. If the index holds above that level with low volatility, the case for a place signal strengthens with each passing session. If you found today's summary valuable, share it with a friend. Both of you will receive 14 extra days of free trial access to the full VIXShield podcast and signals. Your personal share link is waiting for you in your member dashboard. This market summary is brought to you by VIXShield, your protection against daily uncertainty. We are here every market day, and days like today, quiet, disciplined, watchful, are the ones that define how traders perform over the long run, not the exciting days, the patient ones. VIXShield signals are for educational and informational purposes only. This content does not constitute investment advice, a solicitation, or a recommendation to buy or sell any security. Options trading involves significant risk and is not suitable for all investors. Past performance is not indicative of future results. Always consult a licensed financial advisor before making investment decisions. This morning outlook is prepared for educational purposes only. Market conditions change rapidly, and all data reflects the most recent available information as of collection time. Do not trade solely based on this content. And one final note. Today is a hold day. The VIX Entry Gate was not met. No new Iron Condor position should be opened. This